Is it visible for you from your space? Okay, so I should not zoom in further. Okay, so first of all we need the free cash flow, then later on we need the weighted average cost of capital. So we will need the shareholders' equity, and also we will need the long-term liabilities. We need several things here, and then we will have the salvage value, and that's all. Okay, so and also we should make it much more dynamic, so we need to add the next 5 years. So let's see what are the EBIT. So obviously we should refer back to the profit and loss statement. So, yeah. Okay, taxes. Corporate income tax, municipality tax, gained interests, paid interests. Obviously we don't have municipality tax, so we can remove this from the equation. Corporate income tax we have one, so maybe we should extend this to simplify. Also gained interest multiplied by the CAT rate and paid interest. Right now it's utterly useless, but maybe in the future when we have when we solved all these problems, then this cells will contain actual relevant data for us. So corporate income tax is living here in the CAT. We can see that we are not paying so much taxes actually. Yes?
I have a question.
Yes, of course.
For our case study,
Yes.
which we are going to do in the group, and for example, for the cash position,
Yes.
we just have to find ways to reduce costs or increase income in our study with our group, and then do the same Excel sheet like that is there, but with our improvement.
Yes, indeed, indeed. So first let's build up this, or the original setup Excel sheet, and after that I will show you that how can we change the numbers. If we don't have enough time today, then we will just move the deadline week ahead, and we will do it until the first assignment sample is done. So, because before designing that, okay, this was not useful, but still we have to assess that what is the baseline scenario, because in this case we can see the added value of the new strategy. So okay, I designed a new vehicle and so on, but what was the increase in corporate value in terms of money to see that? Okay, but this seems to be, yeah, this is not good. Yeah, it was zeroed out because the first 2 years were zeros, and now this should be a zero because here is negative number. And also this is not paying dividend at all. Okay, so we are paying some nice corporate income tax, gained interests. Obviously the gained interest, so financial revenues, will come from the asset side, so we should also make this a bit more intelligent. In the corporate income tax in France is 0.0 what is this, 26.5%. Okay, but this is not considering anything from the cash reserves. So let's assume always that financial revenues are generated with a year of lag. So if we are generating such amount of profit at the end of the year and it will be reinvested into the assets, then yeah, it will channeled here. So if we start with 0, then the first year will be multiplied with some kind of interest rates. Okay, but what is the interest? So right now the case study says that this. We will update it sooner or later because now I downloaded the most recent French government bond yields for different time periods, but this will be important when we will talking about interest rate risks. So right now, in the second year's financial revenue, we can invest all the cash reserves which were generated at the end of the first year, and we just add how much money can we earn on this. Obviously. Why are you negative? Because this is still negative, okay. Then let's say at least it's 0, so we are not stupid, at least we are keeping it cash in if it's not paying revenues at all. So it's nice. And okay, let's move forward. Paid interest multiplied by CAT rate. Yeah, this is paid multiplied by 0.2065. Okay, spending on this, yeah. So first of all, we did this. Then we have to add them together. With a nice sum function. Okay, so what I mentioned yesterday, that we don't care about spending on investments because it would complicate things, so we will set it to 0. Depreciation. We are looking for the depreciation window. Depreciation right now it's, sorry. So depreciation right now is really simple because we just say that we have all the assets in the property side, and then just we are assuming that sooner or later it will expire. So within 20 years of standard depreciation time, we just use it, and we don't care about that what is a land or what is real estate or whatever. Just let's use a general number because absolutely no data was given in details. So floating capital. Yeah, this is the tricky part because floating capital can be approximated, not here. So floating capital can be approximated by the difference between between the current assets and the current or the short-term liabilities. So practically we can see that the sum current assets but okay, minus the sum of short-term liabilities, and this is where we can create huge problems. So when we have to think about other assets, other liabilities, and already we can see huge numbers here. Usually from valuation we should skip this non-transparent items, because we have no idea what is happening here, but obviously both of them are way more significant than the other items. So I would say that if we can see in a real situation something like this, then we should say that no, let's not include it. So, and the other funny thing is that now it starts to become positive. So still we can think about that loan and receivable. So practically this money is against our own parent companies, it's against our own consumers, so or customers or whatever who is here, because this is also non-transparent, so they should just put up the publicly available numbers, but after that there is no breakdown as what is happening here. So at the end of the day it's hard to decide that it's one-time value, not one-time value, because after that I just made it constant in time. So if we are highly conservative, then we should also exclude this one in terms of valuation. So practically at the end of the day my numbers will be really narrow, because just let's add cash, we know that this is cash, let's add inventories because we can also imagine that is here, but this non-transparent loan and receivable and other things, let's keep it outside. So practically also on the other side we have just the payable component. So what is our relationship with our suppliers, and this is a much better approximation for the floating capital when we are just eliminating all the non-transparent components, because this can absolutely mislead everything. If we would have these huge thousands here, then practically it doesn't matter that what is happening at EBIT or taxes level or at the level of amortization, because this would still, this is biasing so many things, but at least not so much or not at the same degree. So we should add EBIT minus taxes plus amortization, sorry, depreciation, and the floating capital. And then we are the happy owners of the following free cash flows for the different years, which is still highly driven by these guys, but at least not that biased. Okay, shareholders' equity. So we need RE, we need the risk-free asset, so 10-year government bond yield, FF, no, RF. So we are right now building up these equations here. So this is the standard CAPM equation. Okay, we need the market, and also we need the sectoral beta. So we need some subcomponents. Okay, shareholders' equity is really simple because we just have to check the balance sheet. So shareholders' equity, these two numbers together. Wow, they have so huge retained earnings from the past, when the company was actually producing something and they were able to sell something on the market. So let's recognize these two things. Tip. And then we should identify, not you, but these things. So if right now we are going to the Icon database, which is the former Thomson Reuters, and downloading all the data from the French government bond markets from 1 year to 2 years, 3 year, 5 year, and so on until 10-year benchmark yields, then we can see that yeah, these benchmarks had a really terrible time periods when they were close to zero, and obviously there was this peak time period in around the crisis of 2008, and since then, yeah, their value was in the or close to zero or sometimes even negative. But if we are checking the data nowadays, so at the end of the graph, when finally we don't have these ugly negative numbers, what I hated in the past, then we can see that right now at this month, so I downloaded monthly data because it will be completely enough for us. So the monthly data for this thing is 3.2%. So let's add it to our equation. Let's copy it because and okay, so these variables will be not considered as a dynamic variable because we could do it, just it would be even more terrible. So let's use it as a constant. Because right now we are doing the valuation, so it will be solvable, but let's not do this. Okay, and we need to add also one thing that what is the name of the French stock market? CAC 40 maybe? Yes. Okay, so I can download it. Now we need annual data for this purpose. Okay. Whatever. Up. Then we should see the dates. And now we can ask the question that how can we deal with this thing, because we can see that, so how many years should we add to the game? So mostly what we can do here, that let's see the differential from year to year. So this minus this year, and obviously we should divide it with something to get an exact return. So now this can be considered as a percentage. Okay, and you don't have value. And after that, still we cannot just calculate average from this one, because in this case this information here will have the same representation like the information here, which is so somehow we should add the time value here backwards. So let's have a moment. So we need a time index, and also the exponential return. So according to the econometrics book written by Chai, who has it's a terrible book, but he underlines that exponential smoothing requires a lambda value of 0.794 for annual data, and the reason is because this is working that way. So until that point I was always waiting for some nice description that why this thing is calibrated this way, but even if Chai says that the lambda is supposed to be this thing, then it is. Maybe I should turn on the air conditioning. What do you think? Because can you please close the window? Celsius is too cold. If you start to feel cold. I enjoy warm weather, but this is now a bit too warm. Okay. So, exponential smoothing. Okay, so literature says that we just should take the actual return here, multiply it with this lambda value, and this lambda value should be on the power of time. So in the first year, practically it's highly the same because, okay, it's on the first. No, it will be not good. First of all, I should say that this is fixed. Yeah, it's okay. Okay. Yeah, so we can see that now passed on information is so it should converge to 0. If you are comparing these two things with the graph, then we can see that this exponential smoothing is just pushing down everything to the expected 0 value, so it's functioning well. So after that, if we need an average market performance ratio, then we can just say that let's sum, not sum, what is average? Yes, average. Then we start to balance out. So let's see what happens if we are considering just the last 10 years. Uh, 0.4. What happens if we are adding something? So something around 0.4, so 4% seems to be, yeah, but this is also a crisis year. So this can be quite a robust result. So if we are checking years back and forth, then usually we got something 4%. This is still not a percentage. This is how we can also make mistakes. Yep. And now we should just check the Demoderan database. Wow. Yes. I was able to download the right one at the first attempt. It's cool. So this is the most recent one, and it's from Europe. And we are using aerospace and defense beta because this is the easiest way, so practically average. There can be consideration which one to choose, but practically I would like to prefer the levered beta. If you are, according to the literature, some people are absolutely not considering the difference between them, but let's say that right now the beta is this one. Okay, now it's this one. Then CAPM, so risk-free asset plus. This is what we learned on corporate finance when we were bachelor students. So the difference between the risky thing with the risk-free thing, which is not that much, and after that multiplied with the beta, and this is what we should expect from the share. Okay, if we are looking at the poor performance of the company, so 4% of return on these shares annually, maybe they are not that terrible, just Okay, long-term liabilities. Right now we don't have much debt. We have absolutely no debt, just previously we had losses, so that's why I had to modify it. So right now the debt is 3 because it was just referring backwards that the EBIT was negative previously, and that's why I had to take up loans, but now we don't have to, because okay, in the last year we have still losses, but this is the problem for the 6th fiscal year, so right now it's no problem for us. So debt, the company is debt free, and RD, where are you coming from? From there, okay. We are using just this number. So at the end of the day, the weighted average cost of capital should be something like this. So E divided by the sum of retained equity, debt, it multiplies the return. I will use as much brackets as possible, and also we should do the same thing for the second component, just in this case it's multiplied by C21, and we are dividing the debt, which is 3C20. And obviously we should have really close numbers to the RE, because the weight of this thing is can be measured in nearly 3 billion euros, and this is 3 million, so obviously this part is right now doesn't matter, but it's a good thing because we can increase the debt of the company if we need it, because right now we are debt free. Yeah, and also this is not a dynamic variable. Okay, so before dealing with anything with the salvage value, now we have the chance to calculate the discounted cash flow, DCF. Let's underline this. Okay, so not floating capital, where are you? Okay. So this thing divided by the weighted cost of capital, obviously not this way because that would be stupid. So 1 plus thing on the years. So just calculating simple present values, but we have to fix this one with the dollar markings, and then we can see that, yeah, maybe in the future the company is going down. So, but in not that near or far future, the company still has an increased value at DCF level until a bit goes south, but still it can make something. And salvage value must be added now. And this is the big question for us. So what can be considered real estates? So right now we have property. if we are going back to the, okay, I don't need this anymore, also the beta. So if we are going back to the balance sheet, then we can see that we have the property. I have no idea what these investments are, so can we sell it for 20 or 75 million euros? Maybe not. So let's say that, okay, we have the property and we have the intangibles, because there is a chance that we can sell them on the market. Property will suffer from depreciation, intangibles are not suffering from depreciation, so we should consider these two things. Property 5 years later. Okay. Let's keep the structure of the Excel sheet. And intangibles. So we are only dealing with these assets at the long term, so that's why we don't care what is happening from year to year, because we're just saying that, okay, if we are eliminating everything at the 5th year, then what will be the value? And also we just have to look for cash. Inventories, you can say that, but also maybe these are absolutely unique, and also we considered inventories already, so let's just keep the cash reserves. So at the end of the day, we can say that let's sum these numbers up and let's divide it also. Let's calculate the present value of this thing. So that 1 plus weighted average cost of capital on the power of 5, because it will happen 5 years later. So this is the salvage value. Maybe I should move this here, because in this case we can understand that what is this number. And then let's underline it that this is also a significant component. And then the value of equity will be sum of the salvage value plus the sum of these discounted cash flows. But still we should not forget about that we have debt, so practically the value of the company is this thing, but the value of equity is this thing minus the huge amount of debt what we have right now. Still, it can be appropriate, so this is the number what we are looking for. But we can see that this value is absolutely driven by the salvage value. So if we would just focus on DCF, how much money do we have? So yeah. So the company is not that great. And we could calculate also return on equity, return on assets and other ratios, but I think that if we are doing the valuation, it will worth to see that, yeah. This is what we can. So we should be better than this number, than this. Obviously I'm lazy and I'm trying to focus on something which is not optimal, so that's why you are motivated to build better. So let's keep this structure. A year ago I tried to do carbon composite, which was a terrible idea, so maybe not this time. Can we throttle this down? So practically to land propulsively with the rocket, so igniting the engines above ground, and you can slow down the vehicle from Mach 3 to 0 kilometers per hour. Practically you have to be able to regulate the throttle levels at a huge degree, because you have to slow down literally, so you cannot have full speed and 0 speed, so you need something in between. Assume that we can do this with this Vulcane, which is questionable. So right now most of the engines can be throttled between 60% and 100%, and usually it's also enough for SpaceX to land and not to destroy the vehicle. You can ask the question that why not parachutes, because only small satellite launchers, so Rocket Lab is using parachutes to slow down the rocket, but after that they are just fishing it from the ocean. They tried to catch it with a helicopter, but it did not end it well. They always reject the capture, even if it was captured, because it started to drag the helicopter away with itself. So SpaceX tried to use parachutes at the Falcon 9 first stage booster, but right now, so the situation is that you have a 10 storage building size of equipment, which is falling back with Mach something. So they tried to open the chutes, but the vehicle was disintegrating faster than the chute was able to do anything to slow down the vehicle. So propulsive landing is the thing. This is the way. So I should design this thing, and let's say that I just cut the margin. I'm less greedy than the company behind this, so let's go back to the conventional 0.3%, and I try to land this. That's why I'm not an engineer. So yes, these are the numbers, so let's copy it here after I happily deleted it. So first stage landing, rapid unscheduled disassembly probabilities 80. I like the narrative so much, because if something explodes, it's always an anomaly. My favorite was when that was an ESA, so it was also ArianeSpace, but their smaller launcher vehicle, and they said that vehicle is disastrous, so they have always a high chance for mission failure. And there was the live coverage of the launch, and people were talking with journalists and from mission control that, oh, it will be so good to have these satellites in space, and in the background you were able to see that the curve of altitude, that practically it was failing completely miserably and falling back, but they did not realize it for maybe 3 minutes. So yeah. Okay, so we have this learning curve here. So probability of gaining revenue will be already high. Probability of cutting costs by reusing the first stage will be really low in the first year, and then we start to catch up during the next years. Okay, so we have the original launch numbers. We need the launch price. The launch price will come from the cost, because this is the launch price. So this is the price of the equipment. Okay, this is coming from here, so we don't have to care about that one. Number of missions. yeah, we have to open the case study because this will describe us that if we are assuming that we can make this thing fly and land, what is my 55? So on paper we are at the same level like SpaceX Falcon 9, so we will have 4 launches. Yes, but after that market will scale up itself because now it will be 20. $45. Okay, we are limited by the number of weeks, so we cannot reach 80% because in this case, or 80 launches because we need a second launch pad. So, and then 50. Yeah. Okay. Probability is coming from the data. Revenue. It's calculated as well. Probability of reusing the first stage is also here. Uh-oh, and this is when the problems are starting to rise because I zeroed these things out. Yeah, my bad. So probability of first stage usage, we have to copy it backwards. We just have to so this is a highly efficient chart here because practically it computes that how much first stages we should build, because it says that okay, what is the probability of using the vehicle again. So, and we are always assuming that we can reuse a first stage 10 times. That was the original assumption at SpaceX, but after 10 launches still they need a major refurbishment, and now there are boosters with 15 launches, so they are above this level, but let's say that we are conservative. So practically this is where we can cut costs, and we can reuse the fleet of first stages, because we can see that, oh, these are the launch numbers and these are the required first stages, which are not so expensive anymore for us. But second stage, fueling, fairing, solid rocket boosters, they are a lot because we have to build them again and again from missions to missions. So that's why my company will be not so profitable like yours, because I'm not able to cut costs here, and the solid rocket boosters are adding a lot to the price tag. Yeah. Also, if you are checking the sheet here, so we can see that is recoverable costs. So this is just coming from the first stage hull and from the engine. So the rest is coming from the final price tag, and which is not recoverable. So for each launches we have such expenditures, and this is what we can save at the end of the day. If we don't have the solid rocket booster, then obviously this can go down. And also this number here as an average, it's an average if we are reusing it for 10 times. So that's why it can be misleading, because practically this is the price of the vehicle. Just somehow I had to create some averaging to have nice numbers. So what can possibly go wrong? We have nice profits, we have nice depreciation, and we are suffering miserable losses in the first year. So we need runway. This is the exact term. So we have to take up loans, and it means that to deal with such losses, I will put a warning color here. We have to increase the debt. So we can take up loans cheaply right now. Okay, later I will increase these interest rates, but right now we could say that let's take a loan of 200 million euros, because maybe we can say that, yeah, but just for refurbish the whole company, to reorient it, to reinvent ArianeSpace, I would just need to cover these losses of 120 million euros. But let's be conservative and let's say that we are issuing corporate bonds, and after that we are issuing 200. So if something wrong is happening, because usually in this business always something wrong is happening, so there are always delays and so on, so we will not failing like Virgin Orbit did last year, when they had the first launch from British, I cannot say soil, because they were launching from air, from under the belly of a jumbo jet. So they were launching under the wing of this jumbo jet, so the rocket was smaller, but this rocket exploded, and after that they were running out of money, and they tried to sell the company to a venture capital investor, but after that this investor backed away when he was able to see the numbers, and now all the assets are liquidated, and mostly what remained from the company are the patents. So yep, so we can say that let's have more money than necessary, because still paid interests are really low. We will increase it later on, but still it will be a really cheap way to finance the company. Right now we have no hedging exposure, we have no financial lease. We will check it later on. So financial profit, yeah, this is the financial profit right now. Pre-tax profit, terrible, and in this case we don't have to pay taxes. Obviously we have also no dividend payment, and yeah, that's all for the first year, and after that we can see that it starts to ramp up itself. Okay, and what is now the new value of the company? I was able to do something because it was 40 something and now it's bigger. And also if you are looking on the DCF, so it was 1000, so it was 1 billion euros, and now it's nearly 3 billion euros. So I was able to increase by double times the discounted cash flow generation, which is now not driven completely by floating capital. Here, yes, but this is due to the increase in cash reserves. So it's more sophisticated. Okay, so let's write the sample assignment. Sample assignment 1, it should be a title, and I'm in English mode, but still it has the desire to use Hungarian language. And let's not confuse that we are in this state. So, first of all, initial problem. second thing that we should copy the description of the problem. New corporate strategy. A bright new future for European space business, or something like this. Okay, evaluate the pretext ratio. Well, let's copy everything here. Okay, so spacecraft, rocket, launch vehicle. New launch vehicle design, so this will be the other major milestone, and obviously after that, because still we are economists, so we need financial impact. Okay, let's use bullet points. So, what are the initial problems? So first of all, our profit margin was really low, but maybe the most important problem is that the launch numbers are low. So, expected launch numbers. Because since then, many missions, even scientific missions, were moved from ArianeSpace to SpaceX because and not launch. Hello. Hi. High unit costs due to lack of the first stage. So first, lack of reusability of the first stage is one thing. Also, we know that okay. And yeah, so this practically kills our launch cadence because nobody wants to use this platform anymore. Also, if we are reopening the default setup, so we define that we are not able to cut costs. So it's not a so if you are just cutting the number of people, then other space or launcher companies will have more chance to hire or personnel. So practically we are just reinforcing them. So okay, so laying off is not an option, we should keep them, and but also which is a good thing. We could also issue shares, but the company is right now a private company, and maybe major shareholders like ArianeSpace and Safran Engine, they don't want other agents, partners to share with this profit, but we will check it in the future. Just right now, if it's way easier to say that let's take up a loan or issue some bonds, and it will be completely enough. So we have to design propulsively. How many typos? The first stage is reusable. We don't need solid rocket boosters. Also, we could fish out the fairing from the sea, but let's focus on the relevant features. So, new launch vehicle design. So, we are using legacy hardware. Which is already on the shelves, and hoping that it can be reused. So yeah, practically we can copy this table and we are designing a vehicle made from legacy hardware, but we are not doing the same thing like the Artemis moon program is doing at NASA, that they are using legacy hardware, so all the engines are coming from the space shuttles designed in the 70s. The capsule is new on the top of it, but all the logistic life support and other things behind the capsule is designed by the European Space Agency, because that was their previous autonomous vehicle carrying cargo to the International Space Station. So practically the hardware is there since the 2000s, and also the engine for the second stage is with us since the 60s. The solid rocket boosters for the vehicle are coming also from the space shuttle era, just they are elongated, and practically the plumbing, the tanks are new development, but somehow the launch price of each vehicle is around $1 billion. So and the price tag, that's why it's terrible, because they are saying that, oh, this is legacy hardware, just they spent $100 million just to paint and refurbish the launch pad, which was already there and it was serving the space shuttles as well. So yeah. I cannot say corruption because they spend the money well, just the motivation and the efficiency can be questionable. So, okay, so we will be using a legacy hardware, and practically I'm using the most expensive fuel and the already existing engines and aluminum hull. So at the end of the day, we can recover worth of hardware at each launch. Ten times, and after that, let's say that we are abandoning the booster and we are building a new one. So still, it's absolutely not balanced, but this is my stupid sample, so you can do it better. But in this case, it's a 30% margin or launch price can be at what is our what? Yeah, this is the original. Okay. Yeah. So 55. As the company can ramp up the So usually the saying is that during the first 20 launches you will find all the weaknesses of the vehicle. So most of the explosions are happening the first 20 launches, and after that the vehicles are starting to become more and more refined. But 2 days ago Rocket Lab lost one mission because the second stage was not igniting or exploding, but something happened with the second stage. During the 2020s, always the second stages are the worst. In the past, it was always the first stage which exploded on the pod or in the sky or somewhere. Nowadays, people can launch stuff, and after something wrong is happening at 80 kilometers, or they are not focusing so much on the second stage because, oh, the first stage should survive. So now this is starts to become a trend. Yep, okay, and this is not that important. Profit and loss statement. From financial point of view, because this is engineering, so the company first year so we have these losses and therefore it should issue, I hate when it's not my keypad, therefore it should issue okay. And let's copy everything. I'm again in the wrong thing. Yeah. So let's copy everything here. And maybe delete some numbers. Oh no, let's keep everybody here because it will just complicate stuff. Just adding nice lines. Should issue corporate bonds to collect 200 million euros, and after that so after the reusage of the first stage, and the increase in the launch numbers, will scale up the profitability. Usages, that's good. Okay. So this is what we had to do for today. Still English.